Welcome to Bond Pricing 3 in the Investment Analysis playlist on the Options Gambler YouTube channel. I'd like to now note that the bonds we've been talking about in the prior two were referred to as coupon bonds, meaning that they had a cash flow stream that kind of looked like a coupon, and at some point down the road, face value plus coupon, okay? Date 1, date 2, and so on, out here at date and the maturity date. And that's how those work. But there exists something known as zero coupon bonds, and you can guess that the size, the dollar size of a zero coupon bond would be zero. So it's as if we had this series, it's just that all the values of C were zero, which is exactly right, which means that there's only one cash flow. So let's just pretend we have a 5-period maturity zero coupon bond. It's just going to pay the face value, which is always $1,000 at date 5. Okay? So that's the cash flow stream for a 5-period zero coupon bond. It just has one cash flow at date 5. And of course, it's fair value. It's in equilibrium, its price at date 0, call it the value at date 0 in equilibrium, would be equal to $1,000 divided by 1 plus whatever opportunity rate of return y per period is relevant, and we have to raise it to the fifth power just to get it back to 0. Okay, and of course the larger y is, the smaller v0 will be, of course. Okay. Okay, just to make sure, I just want to make sure you realize this is the same as 1,000 times 1 over 1 plus y to the fifth power. Oops, sorry. To the fifth power. Okay, and just it's 1,000 times a present value interest factor, where r is what we're calling y, and n, the number of periods we're moving back in time, is in this case 5. Okay, just want to make sure that you understand that. Okay, so that's a zero coupon bond. Treasury securities that are issued by the federal government in order to fund the national debt are often, I guess, trichotomized is a word. If it's not, we'll make it one. You have T-bills, T-notes, and T-bonds. And the maturities of these is what allows a category to be assigned. Treasury bills have maturities of less than or equal to 12 months. Treasury notes generally less than or equal to 10 years. And Treasury bonds greater than 10 years. Now you might find someone that wants to call a 10-year Treasury security a Treasury bond. Perfectly fine. It kind of means nothing. Okay? So now, but what's interesting is to know that these Treasury bills are zero coupon bonds. In other words, when you buy a T-bill, you are paying a price, something less than 1,000, and you're going to get $1,000 at some point in the future. Well, I guess that's true unless interest rates are negative, in which case you could pay something more than 1,000 and to get 1,000 in the future, and that's something that we'll have to look at in more detail later. But that's kind of relatively new to the world. But in a world where we have positive interest rates, where time value of money is positive even in the short run, then when you're buying a Treasury bill, you'll pay less than its face value. Treasury notes, and so T-bills are issued as zero coupon securities. T-notes and T-bonds are both issued as as coupon bonds. In other words, they'll make, usually it's every 6 months. So at date 1, which is 6 months from date 0, they'll pay a coupon payment. At date 2, coupon payment. Date 3, date 4, date 5. And then just pretending it's a 6-period coupon bond, at date 6, they'll pay 1,000 plus the coupon. Okay? In the analysis we do, by the way, we're not going to get caught up in that silly annualizing convention. We're going to do our algebra correctly, we're going to have our periods be, well, 6 months as it relates to Treasury securities. But we just are going to speak in terms of periods. A per period coupon rate, also a per period yield to maturity. And that's what I've, by assumption, been doing so far. I just wanted to make it explicit here. Okay? So that's a zero coupon bond. Zero coupon bonds end up being very valuable things. We'll talk about them a little later. Okay, so when people are trying to analyze bonds, they typically look at, I guess, the two most important aspects of a bond, and that would be its risk and its maturity. Now, some people might disagree, so I'll just say risk and maturity. And when we talk about risk, we're really thinking about the default probability associated with the bond. And maturity is just obviously maturity, nothing special about that. These are, two categories that impact the yields on bonds. But there are more, and we'll talk about them in a little bit. But just kind of keep these in mind. Generally speaking, the higher the risk, the higher the yield. And the higher the maturity, the higher the yield, generally speaking. Okay, riskier bonds that are identical to other bonds will have a higher yield to maturity than their less risky counterparts, and bonds that are equivalent in all aspects except maturity, generally the case is the longer maturity bonds will have a higher yield to maturity. Okay, and we'll talk about reasons for this as we go on here. But I want to spend a little bit of time talking about excuse me, the meaning of interest rates on short-term Treasury securities. Okay, I've already mentioned that over time, the after-tax yield on Treasury securities has plotted pretty well with inflation that has occurred. So you could kind of think of investing in Treasury securities, excuse me, especially those Treasury securities that are very short-lived, as being investments that one would rationally expect to be compensated, that one would rationally use if they expected to be compensated for inflation. Okay, so a little bit on inflation now. Let's assume that you have $10,000, just graduated from college, and you're thinking about taking a year off. You want to travel in Europe. And if you don't do that, let's assume you go and you spend $10,000 and buy a car and try to find a good job. But you're going to take a year off. And but you're not going to spend any of your money. Maybe you're going to work and travel. We needn't be concerned with the details of this hypothetical. But the idea is you're going to put your $10,000 in some sort of an investment. Okay, so at date zero, you invest $10,000, and then 1 year later, okay, the idea is there's going to be a value for this. Okay, so here's your cash deposit, and then at date one, we're going to look at a value. When I look at values, I put them above the date because it's not an additional cash flow. And in this analysis, let's just assume that our opportunity rate of return is 10%, and therefore we know here the date one balance in our account will be, that's $11,000. Okay, and so I guess the question is, if inflation was 10%, would our purchasing power have remained unchanged? And if we are in a tax-free world, a world where interest income is not taxable, then that would be true. But in our country, interest income is taxable. And let's just assume that our marginal tax rate, MTR, marginal tax rate is 30%, okay? That means of our $1,000 that we receive, 30% of that, or $300, goes to the government. I'm just assuming there's only one government. In reality, you have federal governments that are taxing it, and some states may tax it, some municipalities may tax it, whatever, okay? In our example, we just have one government, okay? And if the marginal tax rate is 30%, then $300 goes, and therefore your balance, this is very important to recognize, that your balance at date one in your account will really be 10,700. Let's assume that they withhold taxes on interest. Even if they don't, it doesn't matter. You've got a liability at that point in time. Okay, so 10,700 is what you have. Now, if inflation had been 10%, it's now clear. So if inflation, P stands for price level. The dot above it stands for the rate of change. So P with a dot above it means inflation that actually occurred. So if actual inflation was 10%, then you, with your $10,700 at date one, will have experienced a decrease in purchasing power because of the fact that the inflation rate exceeded the nominal rate that you were earning in after-tax terms. Yes, you were earning a nominal rate of 10%, but in after-tax terms, you were only earning 10% times 10% times 1 minus the decimal equivalent of 30%, which is 0.3, which is equal to 7%. And that's why you only got $700. All right? So that's one important thing to realize, that in an economy where we have risk-free treasury securities whose income is taxed, that we would expect to see nominal yields higher than expected inflation. Okay, well, that would be the expectation. We see nominal yields higher than expectation. And that has to be the case in equilibrium with rational economic agents if people are to expect to be able to maintain purchasing power. In my example, at date one, when you got back from Europe, you'd only have 10,700, and if the car you wanted, say a 4-year-old used car cost 10,000, then if inflation was 10%, then it's not illogical to assume that it would cost 11,000, but you've only got 10,700, so you've suffered a reduction in your purchasing power. Okay, so that's that. Now, in my example, I assumed that the marginal tax rate was 30%. And we made an observation in our analysis up here. The observation was that in equilibrium, we would expect, now this is expected inflation, EP dot, expected value of the rate of change of the price level, which is the layman's interpretation of inflation. Expected inflation in equilibrium would equal the nominal interest rate, I'll call it I-nom, times 1 minus the marginal tax rate in equilibrium. So in our prior example, if expected inflation was 10%, okay, I'll use decimal 0.1, then we have to solve for the value for the nominal interest rate, where 1 minus 0.3 times that I nominal is equal to that. So this is 0.7, of course, right here. So all we do is divide both sides by 0.7, and we have 0.1 divided by 0.7 is equal to I nom. So something 13-ish%, I guess, would be what you'd have to earn in order to have 10%, a 10% increase in your purchasing power. Okay, so that's very important to understand that. In the email I sent you that had your syllabi and all those files, there is a spreadsheet called Treasury, or maybe T-Security, Treasury Security Auction Send, Treasury Security Auction Send, and look at that spreadsheet, and that spreadsheet will help you understand a more interesting case, and that is the case where we have multiple marginal tax rates, as is the case in a system like ours, where we have a progressive income tax scheme. A progressive tax scheme just means the higher the bracket you have of income, the higher the MTR. So for example, maybe an income bracket from 0 to 20K, marginal tax rate might be 10%, 20K to 50K, marginal tax rate might be 15%, and just pretending 50K up, marginal tax rate is 20%. That's an example of a progressive tax scheme. By the way, just make sure you realize if somebody earns, say, $25,000, they don't pay 15% of all of that income in taxes. The first 20,000 is only taxed at 10%. And then the remaining 5,000 would be in this bracket and would be taxed at 15%. Okay, in other words, you never don't want another dollar, okay, because your marginal tax rates will always be such that you'll get to keep some of that dollar. You could imagine someone, if it was the other way, you'd rather earn 19,900 than a lot of numbers, one of which would be 20,200, right? Because if these rates applied to every penny you earn, but they don't. Okay, so the spreadsheet called Treasury Security Auction Send looks at a case when there are different groups in an economy that have different marginal tax rates, and we look at the spreadsheet is looking at an auction where the government is trying to borrow money, and you have competitive bidders and non-competitive bidders, and the idea is, in the example that's populated, the government needs to raise 100 million, or maybe it's 100 billion, I forget, and the competitive bidders, the non-competitive bidders, people who are just saying I want whatever the rate is, I think they want 55 million, and therefore the remaining 45 million has to come from competitive bidders, and then you have to go and you have to look at the different groups, okay, and so we have the groups which are distinguished by their marginal tax rates. Just make up some numbers here, okay, and then the idea is this is the demand, the dollar demand. So maybe they want 10 mil. Maybe this group wants 7 mil. This group wants 6 mil. This group wants 12 mil. Whatever. And then the spreadsheet allows you to see what rate will be set at the auction. Because, for example, in this case, the government has to go into the table for 45 million, and so it's got 55 million coming that will be lent to the government by non-competitive bidders, and it needs therefore 45 million, and so it's somehow got to go into this and see what interest is for competitive bidders. Maybe there's a group 5 with a marginal tax rate of 40% that wants 30 million. And then what you do is you calculate cumulative demand. Cumulative demand. And then so here it would be 10, here it would be 17, 23, 35, 65. And then you can say, oh, well, look, we need, excuse me, we need 45. We're going to have to go all the way up to the 5th group. Now, by the way, these people aren't standing in line, or they're not separated in a convention hall. This is just a simple example. In the real world, people have different marginal tax rates, and different people, different institutions, different types of legal entities. And so this is just a simplified way of looking at it. But here you can clearly see that the way demand and supply forces will work is that at this auction, if the government wants to really get 45 million, all these people are going to get everything they want, all those people, all those people, those people. Now, not everyone here is going to get it because there's a total of 65 at this point, but somehow the government's got to ration the 65 down to the 45, and there's lots of ways you can do that. You could let these people get everything they want and have everybody here get 1/3 of what they want, because here you're at 35, you need 45, and There's 30 here, so you only need 10 more. So maybe everybody here gets 1/3 of what they want. They have to ration it somehow. You don't need to worry about that. There's lots of ways we could do that. Okay, so look at that spreadsheet. It's called, once again, Treasury Security Auction Set. And Group 0, by the way, is often pension funds. Pension funds are pass-throughs. They have a 0 marginal tax rate. And so if you think about it, expected inflation, if it in equilibrium equals the nominal interest rate times 1 minus the marginal tax rate, if the marginal tax rate is 0, that means expected inflation is just going to equal I nom times 1, or expected inflation will be the nominal interest rate. So if Group 1 has a marginal tax rate of 0, it's probably a pension fund, and it's it's going to be able to maintain purchasing power just by submitting a yield bid that's equal to the expected inflation. In other words, when these entities bid for government securities, they can bid in dollars, or that dollar bid can be translated to a yield bid, because you have, it's especially easy to see if you've got a 0 coupon security, right? Because you have some price that's equal to 1,000 divided by 1 plus some yield for the period. And so if you give the price, then you can determine the yield. Or on the other hand, if you give the yield, you can determine the price. So one or the other. It's especially easy to see when you're talking about 0 coupon securities. Okay, that's enough for this video. Thanks for watching.